Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we dive in, standard disclaimer, nothing here is investment advice. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. Today's guest is the CEO of Miles Franklin Precious Metals and an expert in the gold and silver space. Somebody we always love having on the show. It's Mr. Andy Schectman. Great to see you again.
Jesse, always good to see you, brother. Very, very much appreciate the invitation to come back, and it's great to be here.
Yeah, always love having you on. The people love having you on too. And I want to get started with the Israel-Hamas conflict, which seems to be heating up. There was just recently announcements. I was seeing people post on Twitter that there's been a full-on invasion of Gaza at this point, whatever you want to call it. I'm staying out of the politics of this one because it seems like social media is awash with people speaking up for both sides. I personally have zero knowledge of this conflict. I'm not an expert on it, so I'll reserve judgment for what actually is going on. But this is an investing show. So I have to ask, how do you think this conflict could affect the gold and silver markets, particularly if it heats up? We're having further talk of the US and Iran getting into it. How do you think this could potentially affect the precious metals moving forward?
Well, I mean, look, and all commentary on the war aside, this could very, very well spill into a much larger conflict, a regional war, if you will. Um, and when you realize that, you have the majority of the world's oil production in now controlled by the BRICS nations. Um, you have Saudi Arabia, Russia, United Arab Emirates, Iran. These countries are more or less diametrically opposed to our ideology. You could call it an oil embargo as a result of uh, what's happening in the Middle East against the West. You could see it turn into something much deeper than that, what I've been focusing on for 3+ years, and that is Saudi Arabia and the rest of their OPEC brothers and sisters, all of whom are on the Belt Road Initiative, say, you know what, listen, you guys are going green, and this is kind of you've signed an executive order to do it. This is kind of the straw that breaks the camel's back in terms of our massive divergence in ideology. For 50 years, you protected us. We've valued oil in dollars. As a result, we've put the proceeds of those dollars and that oil sales into treasuries. The last 2 years in treasuries have been a disaster. We're down 50%. You're inflating your dollar. And you are on the side of these geopolitical events that we don't agree with. And so, with all due respect, we are now breaking the dollar peg for purchasing oil. And like that, everything changes in the blink of an eye as the world, who has had to stockpile dollars for 50 years, Jesse, to buy oil, creating a synthetic demand, no longer has an incentive to hold them. In fact, is incentivized to sell them. And I think when you talk about the fact that at the very least we should expect much higher oil prices, anything we do, from surfing the internet to mining to farming, anything has an impact with higher energy prices and inflation. And I think that the ramifications that this will have in the treasury market is something that will continue this downdraft of treasury values and increase in rates, which will push, I believe, the very sophisticated investor, let's say the central bank level investor, the commercial bank level, the big money, I think, is diverging away from treasuries, which, I don't think there's much of a coincidence, had their worst year ever in the 10-year treasury last year. Um, and at the same time, we see the central banks buying more gold than ever. In fact, this year, those numbers are up 14% year over year. And last year was the biggest year ever. The last 18 months is the most gold buying the central banks have ever done on record. So this is the beginning, as these types of investors, like the central banks, are always 3, 4 steps ahead of the crowd. They know the playbook. They see where this is going. They're selling treasuries. They're buying precious metals. I think the world is shifting, especially in times of turmoil, away from debt instruments and promises and over leverage into something that the world has collectively agreed to, as wealth. They've agreed for 5,000, 6,000 years that gold and silver are wealth. And I think we are seeing a shift in that direction. And as all of this geopolitical chaos accelerates, 2 wars happening that could quickly escalate into something far worse, far, far worse. Hopefully, God willing, it doesn't. But I think the shift is not about return on your money. It's more about return of your money. And I think this is why you're seeing this concerted effort by the people who are ahead of the curve, already making a concerted effort to slowly sell dollars, sell treasuries, and accumulate precious metals. I think this is just the very beginning. And it's this type of conflict that could rapidly change the backdrop. I mean, exponentially so if we lose the petrol peg. Feels to me like that's almost inevitable by this escalation.
And you mentioned rising energy costs there. I definitely agree with you that that seems to be in the cards for the future. I'm wondering if you think that rising energy costs could affect the mining industry, in particular gold miners, silver miners, but the mining spectrum across the entire range of metals, because obviously energy costs, input costs into mining are one of the main factors they have to take into account. So do you think this could affect the miner's ability to extract minerals? And could that lead to a point where the price of gold, for example, just needs to go higher for them to be able to make it economically viable for them to extract it?
Well, more so in silver than in gold. At least gold is close to its all time high, 10% or so. Silver's under half of its all time high. And that has killed all incentive over the last several years for exploration. And, I don't know what the lag time is from exploration to discovery to production, but I would assume it's quite lengthy. And so this is already happening. It will only accelerate as the cost inputs go higher. And so it's a situation where in silver in particular, like if you look at all the silver that was mined last year, somewhere in the neighborhood of 1 billion ounces roughly, only 350 million or 35% of it came from companies who mined silver. The rest of it was byproduct discovery, where companies mining tin or copper or gold or something will say, oh, look, we found some silver. So yeah, I mean, it's a very small mining industry. I think your point is valid in anything when you're talking about from farming to mining and anything in between where you use lots of energy to move the earth and to accumulate metals or to accumulate a harvest, plant and reap the harvest. You need lots of energy, and as the cost component goes higher, so too does you have to pass that price on, and also it becomes harder and harder, in particular with mining, to especially when you're exploring, you're hoping you find something, you're spending an awful lot of money, increasingly so in terms of energy, to hopefully find those deposits. So yes, there's no question, but that rising energy costs would be one of the biggest factors to or deterrence to the mining industry being successful, and in particular finding new deposits or exploring altogether. So yeah, it definitely will be a headwind to the mining industry.
Well, let's switch over to consumer confidence, because the Conference Board Consumer Confidence Index in the US was just released, the latest edition. It indicated that consumer confidence fell once again in October, marking 3 consecutive months of decline. They stated in their report that consumers continue to be preoccupied with rising prices in general and grocery and gasoline prices in particular. Do you see this trend continuing, and how bad do you think it could get?
I think it get very bad. You know, this index that you're talking about, it measures how optimistic or pessimistic consumers are regarding their expected financial situation. And I use the word expected because it's looking into the future, basically. And um, these people who have been following the mainstream, if they only would have been listening to you and me and others like us in this industry for the last few years, it wouldn't be such a shock. But I do believe that it will only get worse. As we've talked about the rising cost of energy, that certainly is a major component in those uh, areas that you bring up. And then you talk about, let's just talk about where we are. I mean, for the first time ever, Americans need $114,000 in income to afford a typical house. This, according to a new survey that just came out, up 90% from 2020, which you needed $60,000 a year. As rates have gone higher and house prices have gone higher, we have a record $17.1 trillion, Jesse, in household debt. A record 12 trillion in mortgages, a record 1.6 trillion in auto loans, and massive foreclosures and delinquency payments in the auto loan sector. We have the largest asset of the United States government is student debt of 1.6 trillion. That's also a record. It's a asset to the US government in a very sick and perverted way. They consider it that, but it is a massive liability to the young people of this country. And it is a record amount that just started after their forebodings. They're now having to pay that. Again, we have a record 1 trillion in credit card debt. These are all record amounts of debt. At the very same time, we have, for the first time, 65% of the United States living paycheck to paycheck. 45% of the United States earning over $100,000 a year, earning over 100 grand a year, paying or living paycheck to paycheck. So yes, I think when you take a look at a situation where people say, well, I got a 3% mortgage, at least I'm okay there. Well, that's great. But if you don't have savings and you lose your job in an economy that's slowing as rates are rising and liquidity is draining out of the system, and you lose your job, then what? So we haven't seen this bloodbath in residential real estate yet, because almost every mortgage in the United States is under the current levels that we see today of nearly 8%. But in the last year and a half, the cost of mortgages has risen by almost 90%. And a 3%, or I mean, a $400,000 loan at 2.9%, it's like $1,600 a month. You put it at over 8%, you're at $3,000 a month. So in a span of 2 years, the same house, your payments are double. And so it's a situation where people are trapped. They can't leave. They can't even move laterally. They can't pull out that equity and move to somewhere comparable, because the prices of homes have not come down to compensate or to find some sort of symmetry between rising interest rates and overvalued asset prices that reached that level due to a decade worth of suppressed interest rates at zero on the federal funds, and 4 years worth of money printing, whereby more money was created in the last 4 years in the history of the United States preceding. And it created huge distortions in asset prices. So everything is really, really messed up right now as it pertains to the majority of the consumers in this country. And, record indebtedness, record low savings, record government indebtedness, markets that are asset prices that are just screwed up with no price discovery. Because, you take a look, the big elephant in the room is the debt market, the bond market. And for a very long time, all of these things like stocks and real estate are a derivative of the debt market. In other words, if interest rates are low, well, asset prices go up, derived by the low interest rates. You could argue that real estate is a derivative of the bond market, of the debt market. And as the rates go up, those things start to move in the opposite direction. They haven't snapped yet. But I think people feel the strain. I think people see that it costs more to buy food. It costs more for insurance. It costs more to send your kid to college. I mean, all of these things that are inflating, are real. And if it costs more to fill your gas tank, exponentially more. If it costs more to, for the farmer to grow the food and ship it to the grocery store, which ends up on your table, all of this is not going away anytime soon. And quite to the contrary, I think inflation will go much higher and much, much higher. I mean, you take everything out of the equation, we have 130 trillion in unfunded liabilities, Medicare, Medicaid, Social Security, government military pensions. Balance the budget today. We still have all of that unfunded liability, and it has to be paid somehow. And our manufacturing base is gone. We don't produce anything anymore. How the hell are we going to do it? Taxation, inflation? I don't know. But I do think that, yeah, this is real and will only get more real as people have to realize that the information that they're being fed by the Bureau of Labor Statistics regarding the inflation rate, regarding the unemployment rate, so much of what we are being fed isn't true. And so it's taken, there's a lag time between people's eyes and gut telling them, well, hey, this doesn't seem right to me. So, yeah, I think that also, in terms of consumer confidence, is a trend that is only going to accelerate. I wish I didn't feel that way, but I do.
Well, let's switch from the US over to Japan because the Japanese yen continues to face headwinds as the Bank of Japan has announced alterations to their yield curve control program for Japanese bonds. Bank of Japan Governor Ueda said in a press conference, uncertainty is extremely high within both overseas and domestic economies and financial markets. We decided it's appropriate to increase flexibility so that long-term yields can be smoothly shaped according to different future scenarios. That sounds like some Fed speak right there, central banker language to confuse the masses. But meanwhile, gold continues to rocket up when priced in yen. If you look at a chart of gold priced in yen, it's just been going parabolic. What does this signal to you?
It sounds a lot like what's happening here in the States, only we're not honest about it. When Japan and China and Saudi Arabia and all these countries are selling bonds, are we to believe that the Cayman Islands is the largest purchaser of our debt, or is it the Fed who has a shadow account over there that is in their own way controlling the yield or yield curve control, not letting rates get so high that it blows things up? Now, certainly not in the manner that Japan does, where their rates are like -1% or a tenth of a percent. Even they're talking about letting rates go up to 1 or 1.5% on a 10-year Treasury. I mean, that just seems incredible. But look, you can't manipulate interest rates, and this is the problem that got the U.S. This is what got the U.S. into the problems. That manipulation of gold, manipulation of the markets. It's manipulation of interest rates. The market is supposed to control the interest rates. And if you have the bankers do it, you create massive distortions. And that's going to happen here too. Look, you have this widening gap right now between the US and the Japanese interest rates. And this is why the yen has lost almost 15% against the dollar right now. And it's very close to its 3-decade low. I think its 3-decade low is around 152 or something, 153. It's real close to 150 right now, somewhere in that neighborhood. But as a currency falls in value, its depreciation increases inflation in two ways. And this gets into a little, kind of gets into the weeds. I'll try to make it as simple as possible. There's cost push and demand pull. Inflation. Well, if you realize that, first, the price of goods and services that are produced in other countries relative to those produced domestically, I don't care what currency is falling. You could say that if the dollar was falling, it would be the same thing if it was falling in relation to the yen, or the yen falling in relation to the dollar. It doesn't matter what country, but as your currency falls in relation to other currencies, it just gets to a situation where you have to pay more to buy imported products. The same product you bought last month costs more today because your currency fell in relation to that other currency. And companies that rely on imported materials, like Japan makes great automobiles. I'm quite certain they have to import a lot of the raw materials to build their automobiles. So as the cost of those materials in production goes higher, they have to pay more to buy these inputs. The price increases of these imported goods and services, it contributes directly to inflation through cost push. In other words, everything costs more to produce or to accumulate as your currency falls. That's price inflation. By the second measure is when you talk about foreign demand. And in other words, Um, if our dollar is much stronger than the yen, we will buy more cars and electronics from them. Okay, so that's the demand pull, and that occurs because the exports become relatively cheaper for foreigners to buy. So that would lead to an increase in global demand for their cars and their electronics because it's cheaper. Their yen is cheaper, right? So at the same time, the domestic consumers in Japan and their manufacturing firms are reducing their consumption of more expensive imports and shifting their purchases towards their domestically produced goods because it's cheaper to buy in yen than to buy in dollars. This also leads at the same time to the foreigners buying more from Japan because it's cheaper. And so this puts lots of pressure on the production and the capacity and the increasing um, uh, need for these companies to raise their prices. The Japanese firms will have to raise their prices because of the demand and because of the cost of inputs going higher. It's a vicious circle. So it's somewhat, look, economics is always kind of hard to wrap your head around. But the bottom line is, as the currency falls, imports become more expensive for Japanese and exports become more attractive for foreigners. And all of it puts inflationary pressures on Japan. And as inflation rises, if they don't raise rates to compensate for that, then everyone's going to dump the yen. Why would they want to hold a yen where inflation is higher than the rate of inflation? Or rather than the rate of return. That kind of sounds like what we see here in the United States on a larger level, and that's why we're seeing treasury bonds dumped in favor of something like gold. It's a very complex situation, but the bottom line is simply this. If you try to control Mother Nature, you try to hold back interest rates when the world would say, well, your currency, if we're going to hold that, we really think we should get a higher return. The market should be saying that, not the bankers. It creates distortions, it creates anomalies, it creates problems. And when those problems unwind, like we're going to see here in the United States, I would argue the consequences are often exponentially greater in the unwinding as the benefits were in the suppression. So it's not a good thing. And it's going to ultimately lead to, in a country that supposedly has had very low inflation, Japan, for quite some time, under 2%, I would expect we see inflation rise quite a bit. And if the yield control doesn't get out of control, where they just have no ability to hold it back anymore, the distortions they continue to create by suppressing will only make the ultimate outcome that much worse. It is not a good thing. Yield curve control is unnatural and it's a bad thing.
Let's talk a little bit more about central bank gold buying. You touched on it earlier. We've spoken about it in previous interviews, but the World Gold Council just released its Gold Demand Trends Q3 2023 report, where it stated central banks have bought a net 800 tons of gold so far this year, the highest on record for that 9-month period. While there is a nucleus of committed regular buyers, the range of countries whose central banks have added to their reserves over recent quarters is broad based. So it continues to impress me just how many central banks are accumulating gold at a record pace. Could we get into an arms race type situation where central banks are all trying to accumulate as much gold as they can and there might not be enough physical gold to fill their orders at some point?
I think that's why they've used the Western suppression to run cover for their accumulation, which I would argue has been going on at least since 2017 or 18, when you saw the repatriation by the central banks from the New York Fed and the Bank of England, starting with the Bundesbank. And in 2018, all of a sudden, those banks bought more gold that year than they did in the 60 years previously combined. That would be like the Dutch National Bank, the Bank of Hungary, Turkey, the Czech National Bank. All of these countries have been on a buying spree, many, many others, on a buying spree, of course, China and India and all of those. But look, let's just, again, like I said earlier, from a historical point of view, using government treasuries and bonds as a savings vehicle is a relatively new concept in the historical context. And I think it's fading. And I think that already the elite have rediscovered gold is and has always been the premier store of value. And I think it's happening in a big way. And as you mentioned, last year, the central banks bought 37 million ounces of gold, a multi-decade record. Over the last 18 months, they bought more than in any time in history. And, so if you talk about this year, you're right. They bought 800 tons so far in the first 9 months of the year. That's up 14% year over year. Last year being the biggest year on record, and now it's up another 14%. And I think, in short, we're on the verge of this shift from in international finance, and gold is going to replace the treasuries, I think, as the premier store of value. And it is happening. And at the same time, these central banks not only have been voraciously accumulating it while using the suppression of the Western paper market to run cover, where you have 35 times leverage and you can short the market on paper and buy the physical without really the whole world jumping into it because of the price going to the moon and attracting attention. In fact, quite to the opposite. The counterintuitive price action and the suppression of the market has enabled these big players to front run what is ultimately going to happen. And I don't think we've begun to really see anything yet as far as that is concerned. These traders are always way, way, way ahead of the curve. And when it breaks when there just isn't any ability for the Western suppressed markets to suppress in a naked fashion. In other words, it will be far too dangerous to sell short. Let me say what I mean by naked. Right now in silver, as an example, there is 1,700% more paper contracts than there are bars backing those contracts. In other words, it's rehypothecated 17 times. And so if for every one real contract that could be delivered in physical form, 16 won't be, or 17 won't be. You get paper settled. It is rehypothecated. And that's why we're already beginning to see in China, as an example, the Shanghai Gold Exchange has gold price, last I looked, at about $100 higher than the LBMA or the COMEX price. I don't care what these economists tell you is the justification. In my mind, they are trying to arbitrage slowly whatever is not nailed down. And they've already done a good job at pulling stuff out of the COMEX, out of the LBMA. They're pulling the physical commodities, not just gold and silver. You're seeing the industrial metals too, aluminum and zinc and copper. They're all being accumulated by these nations, and they're using the suppression of the Western markets to do it. At the same time, they're selling treasuries. So if anyone wonders why the treasury market experienced its worst year ever and the yields keep rising and the back end of the curve keeps rising, because they're all dumping their long treasuries. And even at a loss, I think they would rather sell them and shift and transition to gold before things get really dirty. So yes, I think that what we will ultimately witness is a moment in time where the rehypothecated levered Western paper markets will enable the rest of the world to siphon everything out of the weak hands of the West, and it will all move eastward. And when all of the metal is there, or the majority of it, where the Western markets are rendered neutered or a scam because of their hypothecated model, then you will see other parts of the world establish a more reliable and credible benchmark, whether it be in Abu Dhabi or the Shanghai Gold Exchange or the Moscow Metals Exchange. It will be that portion of the world, those who have been accumulating it all, who produce it all, who understand what it really means. They're going to say, we don't want to buy from your Western system anymore, and we don't believe in your Western system anymore. And in fact, we are going to implement our own system. And, you can see how banks will arbitrage for a few cents a share, millions and millions and millions of dollars. Well, how about $100 an ounce? How about putting silver at $50 and watch what happens to all the silver over here that immediately arbitrages over there in a one-time shot to make these bankers very wealthy. And now we have stripped clean all of the physical silver and gold that would have been available for the people in this country who will wake up last minute and say, whoa, geez, I better get something. And it will define this market, the inability to source product on every level. And that's when the price goes parabolic. That is when the levered paper price on the COMEX, which currently is over 30 times leverage, where all it takes for a company like me to control 100 ounces of gold on COMEX is $7,000 in my margin account. Well, what if I have 500 million in my margin account like JP Morgan? Well, I can control 30 billion in gold futures. Do you think I can control the direction of the market or create a perception of reality? What if I'm told by the government, listen, we want you to do this. We want to, keep the bond market stable, keep the dollar stable. We need to accumulate some silver. We need it for all of these things, and we've sold most of our silver. So let's just go ahead, short the hell out of it. You're not going to get in trouble, even though it's illegal, even though it's concentrated, and we're telling you to do it, and violation of antitrust law or whatever it may be. Look, J.P. Morgan, when they paid this fine, well, what about J.P. Morgan? They got in trouble. Sure, they did, right? They got 3 people in jail on very, very short jail sentences. They were brought up on RICO charges. No, they just got spoofing instead. They were fined $920 million. Well, that's the largest fine that the Treasury or that the Justice Department ever handed out at that time. Yes, it is, but their metals desk made $1 billion that year. They walk away up $80 million, and they're still allowed to be the custodian of the world's largest silver trust, amongst others, SLV. So when you talk about perhaps this is being kind of looked the other way by the authorities, allowing these banks to hold down the price of gold and silver because what it represents to a dollar and a bond market that are rehypothecated, that are showing the signs of fragility in the system, they've been able to do that for a long time. But the problem is when they started doing this, you didn't have half of the world with the wherewithal or the understanding or the demand to siphon all of these commodities at subsidized prices. Go ahead, suppress it. We're going to stand for delivery. So yes, it will ultimately be the defining characteristic of this market. Not only will it be much higher prices, it will be that the majority of what is available is on the other side of the globe, and it ain't ever coming back.
I want to get your take on a quote from Michael Oliver of Momentum Structural Analysis. He recently said, "We argue that monetary metals are likely on the cusp of a dynamic tonal change in their uptrends, from an arm wrestling process, now 8 years old, to more rapid and vertical. And this as the broken bubble assets hasten their downside dynamics." So, obviously, Michael pays a lot of attention to the technical side of things, and he sees gold and silver accelerating to the upside as overpriced tech stocks enter a very deep correction. Do you see something similar from a fundamental perspective?
Yeah, I do. He's one of my favorite. He's one of the few that talks about momentum analysis, and I love listening to him. And I mean, when you talk about momentum that has propelled the stock market, you have 7 stocks that have kept the market afloat, and they're all tech based. In fact, it's funny, the one shining star, Nvidia, is a Taiwanese stock, I believe. So, you got these dynamics where the U.S. printed all this money, and much of it has flowed into the tech sector, in particular AI. And but in an economy that is slowing the way that this one is, in an economy that is seeing the credit or a shortage of credit, a credit crisis, as far as I'm concerned, the liquidity being drained out of the system, that's a very dangerous place to be. I do believe he is right at that point. I do. But I also believe, as I said now twice, that we are on a shift away from treasuries into precious metals as a store of value, which could be a massive injection into that market. And let's not forget that, over the past 120 years, right? Anytime 100% of countries that cross over the 130% debt to GDP have defaulted on their debt. And it's usually due to massive inflation, hyperinflation, instead of outright default. But whether it be a inflationary default or an outright default, every single country over the last 120 years that has gotten to 130% of debt to GDP has never come back. That's where we are. The U.S. government really can't repay its debt, and default, in my mind, is inevitable. And as a result of that, holding U.S. treasuries would be as dumb as building a mud wall. So I think the alternative to the elite is gold, and it will soar. And I don't expect an explicit default unless, of course, Saudi Arabia and OPEC dump dollars. as the store of val or as the petrodollar, which I believe is highly likely ultimately. And then you have a villain to point to for your default. It was OPEC and Xi Jinping and Putin. How could they do it to us? But I think if I were going to make a trend, the only trend I would add to Michael's statement, which I believe both. I think AI is certainly overvalued and could very well transition out of there as the economy starts. Money would transition as the economy begins to slow. But by the same token, I would say precious metals go higher. I agree, but I would also say that we will move into a period of time where treasuries are no longer the go-to store of value. And that I really do believe. That's the only thing I would add to what he's saying, but he's a brilliant guy. I'm sorry for the noise in the background. We're having bathrooms redone upstairs. I hope that's not coming in too loud.
Oh,
But
good.
anyways, bottom line is that, yeah, I think that he's right. He's spot on. I think that one area is massively overvalued, one area is massively undervalued, and one area, the treasuries, is going through a once in a generation shift of recognition, and I think it's going to be a very bumpy ride. So when we talk about owning precious metals, Jesse, I don't tell people to do it to get wealthy. It is wealth. Wealth that has outlived every transition, two world wars, German hyperinflation, the Great Depression, every pandemic, and it will still be wealth when this situation ends too. And evidenced by the fact that the people who are writing the playbook, the central banks, well, they're loading up on it as if it was really important. So it's the suppression of the Western paper markets that has enabled them to do this without people catching on because the price hasn't exploded, and in particular in silver. So yeah, I think what Michael is saying is 100% spot on, and he is someone everyone should check out. He's really a fantastic analyst. He has my great admiration and respect.
Yeah, absolutely agree with you there. Well, Andy, it's been an awesome conversation as always. For those who want to learn more, could you tell us about Miles Franklin Precious Metals?
Yeah, just send us an email at info@milesfranklin. Ask any questions at milesfranklin.com. Any questions that you may have regarding anything we've talked about here or investing in metals, the price sheet that we will send you from that email will be much more competitive than what we list on our website, milesfranklin.com, where you're only able to purchase up to $10,000. Anything larger than that or a different look, send us an email, info@milesfranklin. We've been doing this for 34 years this February. Never had a customer complaint. And it's something that I'm very proud of. We're not perfect. We make mistakes. We try our best to make it right if we do. And I want everyone to know unequivocally that we do not sell gold as an investment. We are not telling you to buy numismatics. We are not telling you to do anything that with the intention of becoming wealthy. We are helping you get out of the way of what's steamrolling our way. And if you don't see what's coming, you can't get out of the way of it. And conversations like this, I hope, just open people's eyes just a little bit to do their own due diligence and ask themselves if the biggest, most sophisticated money in the world could care less about the price of gold and silver and continues to accumulate it and remove counterparty risk by taking it back, repatriating it from what were traditionally the stores or the places to keep it, because it was the kind of the exchange. So keep it at the New York Fed where it's safe and you can trade on the NYMEX or the COMEX. Keep it at the Bank of England, trade on the LBMA. They said, no, well, thank you very much. We'll take possession of it ourselves. And so repatriation and massive accumulation by the largest, most sophisticated, well-funded, and well-informed money in the world is all you need to know. We are all being misdirected. Misdirection is a very popular theme in finance, in business, in anything where there's an opponent or a competition. The idea is to misdirect. I don't care if it's sports or chess or business or finance or law, you misdirect your opponent. And that's exactly what is happening here. The rest of the world is trying to de-dollarize and accumulate hard assets using the Western paper leverage to misdirect and to quietly enter that space without paying an arm and a leg, because if everyone knew what the playbook was, everyone would run. They'd be crowded out of the trade. The price would go up. Everything would disappear. But instead, if you can create a perception of reality with leverage and misdirect, like the book, The Art of War, the no-look pass in basketball. That's what they're doing. And they're accumulating copious amounts of real world commodities. As Zoltan Pozar calls it, Bretton Woods 3, a system that will be defined by transparency in commodities. No longer opaque debt instruments and promises, but commodities and transparency. And I would argue a mutual beneficial alignment. And that is exactly what these nations are coalescing against the Western hegemony. It's safety in numbers, it's mutual beneficial business deals. Instead of through coercion, it's through cooperation. And these are the things that are happening. It's a trend that I see continuing. So when you think of buying gold and silver, it's not to get wealthy. It is wealth. And that would be my final thought.
Well, I will put a link to Miles Franklin website in the description below. Thank you once again, Andy. It's always a ton of fun speaking with you and looking forward to doing it again.
Yeah, brother, you stay well, man. And I know you're over on the other side of the world there, but it's really good to see you, and love to come back and do it again soon. You're one of the good guys in this industry, and it's always a joy to be with you. So stay well. Thanks for having me. And until we meet again, I'll look forward to picking up where we left off.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.